In 1929, the world discovered how quickly prosperity can turn to panic. One moment, Wall Street was unstoppable. The next, it was dust. Fortunes vanished overnight. Banks slammed their doors shut. Millions watched their savings evaporate. Most people treat it as a closed chapter, a tragedy of the past. But what if it never truly ended? What if the same forces that fueled the Great Depression are still shaping your life right now? If you've ever wondered why everything feels more expensive, why homes are unaffordable, or why debt grows faster than wages, you're not imagining it. What's happening today isn't random. It's the echo of a system built on greed, risk, and illusion. Before we go further, tell me in the comments, where are you watching from and what time is it there? I love seeing how far these stories travel. And if you enjoy learning how money, markets, and power really work, make sure to subscribe because today's story will permanently change how you see every headline about the global economy. Now, let's rewind to 1929. The world was drunk on optimism. Stocks were soaring. Everyday people, teachers, farmers, mechanics, were borrowing money to buy shares in a market that could seemingly only go up. Newspapers called it a new era of prosperity. Sound familiar? Everyone believed the old rules no longer applied. Technology was booming. Credit was cheap. Politicians promised endless growth. And beneath the surface, a familiar pattern was forming. Debt stacked on debt with confidence as the only glue holding it all together. In the years before the crash, speculation wasn't just in stocks. Real estate was booming. Banks were lending recklessly. Companies were inflating profits. Consumers were buying luxuries on installment plans. The entire culture was built on borrowed money and blind faith. And like every debt-fueled celebration in history, it ended the same way. In October 1929, panic spread like wildfire. Investors rushed to sell. Prices collapsed. Within days, billions in paper wealth vanished. The system that once looked invincible cracked open to reveal a hollow core. But here's the part most people miss. The crash wasn't the cause of the Great Depression. It was the symptom. The deeper problem lay within the system itself. Too much debt, too little real income, and too much belief in rising markets. Sound familiar again? Because those same conditions exist today, only bigger, faster, and global. Instead of ticker tape and telegraphs, we have trading apps and crypto charts. Instead of margin loans, we have credit cards, mortgages, and trillion-dollar deficits. The illusion just wears sleeker clothes. Modern economies survive on consumption, but consumption depends on confidence. And confidence is fragile. When people trust the system, they borrow, spend, and invest. When that trust cracks, everything freezes. That's what happened in 1929, and it's exactly what policymakers fear today. The real danger isn't a crash itself, it's what happens when belief disappears, because when no one believes the system will hold, they stop playing the game. Let's talk about debt. In 1929, household debt in America had climbed to record highs. People bought cars, radios, and homes they couldn't afford, convinced that wages and prices would rise forever. In 2025, global debt has exploded to over 300% of world GDP. The pattern hasn't changed. We're still spending tomorrow's money to survive today. Back then, banks sold risky loans disguised as opportunity. Today, they sell the same thing, just wrapped in complex financial products with modern names. The tools have changed, but the psychology hasn't. During the Roaring '20s, inequality hit historic extremes. A small elite controlled most of the nation's wealth. The rest, the workers, the farmers, the middle class, survived on credit and hope. When the bubble burst, they were left with nothing. Look around now. The top 1% owns more wealth than the bottom 90% combined. Corporate profits break records while wages stagnate. The middle class is squeezed, turning to debt just to maintain the illusion of stability. It's the same story, rewritten for a new century. Back then, the Federal Reserve kept interest rates low to fuel growth, then suddenly raised them to curb inflation. The result? A liquidity crunch that choked the economy and triggered panic. Today, central banks face the same impossible choice: print more money to keep markets alive, or raise rates and risk collapse. Either way, confidence trembles. History is repeating, only slower and on a global scale. And then there's speculation. In 1929, people poured their savings into stocks they didn't understand, simply because everyone else was doing it. Today, it's meme stocks, crypto tokens, and speculative manias that look different but feel the same. The psychology hasn't changed. Greed, FOMO, and belief in effortless wealth. When prices rise, people call it intelligence. When they fall, they call it bad luck. The Great Depression exposed an uncomfortable truth. Systems built on inequality and debt collapse under their own weight. The question isn't if, it's when. And if we're honest, most modern economies are running on borrowed confidence. The warning signs are everywhere: record household debt, corporate defaults, and governments printing money faster than ever before. But there's one major difference. In 1929, the financial system was smaller. When it fell, it took down millions. Today, it's global. A single shock in one country can ripple across continents in seconds. The stakes are higher than ever. What happened in 1929 wasn't just a financial crash, it was a failure of imagination. People believed prosperity was permanent. They couldn't see how fragile the structure beneath them really was. And we're doing the same thing today. We trust central banks and politicians to keep the illusion alive. But stability built on speculation and debt isn't real. It's borrowed time. The lesson of 1929 wasn't learned. It was forgotten. Because every generation believes they've built a safer system, that this time is different. But the patterns whisper otherwise. The Great Depression began with a few bad days on Wall Street, but ended with a decade of hardship, deflation, and lost trust. The danger today isn't that history repeats, it's that we keep repeating history. And if the same forces are back again, one question remains: what happens when the illusion finally breaks? By the early 1930s, that illusion had already shattered. Bread lines stretched around corners. Banks failed by the thousands. Families lost their homes, their savings, and their hope. What began as a market panic turned into a social crisis. Governments scrambled to respond, but their tools were blunt. They cut spending, raised tariffs, and deepened the collapse. What started as fear became a decade-long wound that reshaped politics, economics, and the world's faith in capitalism itself. And here's the uncomfortable truth. When cracks appear today, our leaders reach for the same tools: printing money, cutting rates, and promising stability. They treat the symptoms, not the cause. The global economy now floats on debt that can never be repaid, held together by central bank intervention and public belief. And that belief, it's the most fragile currency of all, because when it breaks, history doesn't repeat, it rhymes. In the 1920s, speculation was powered by leverage. Investors borrowed up to 90% of the value of their shares. When markets dipped even slightly, lenders demanded repayment. Margin calls triggered forced selling, prices collapsed further, and the fall fed on itself. In today's world, leverage hasn't disappeared. It's just been hidden under layers of complexity. Hedge funds, derivatives, and unregulated financial networks quietly amplify small tremors into potential earthquakes. The tools have changed, but the essence hasn't. Too much risk, too little transparency, and far too much faith in models that crumble the moment reality shifts. During the Great Depression, it wasn't just markets that failed, it was trust. First in stocks, then in banks, then in the very idea of stability. When institutions locked their doors, depositors were left with nothing but fear. In response, the US government created the FDIC, a promise that savings would never vanish again. It worked, for a while. But the scale of modern banking is far greater. When Silicon Valley Bank collapsed in 2023, panic crossed borders in minutes. The same fear, the same fragility resurfaced, just faster and louder. What made 1929 so destructive wasn't only financial, it was psychological. People believed progress was permanent. Prosperity had become a belief system. When that illusion broke, the damage wasn't just economic, it was spiritual. The same danger lingers today. We've been conditioned to think central banks can outsmart the cycle, that recessions can be managed, and downturns prevented. But every intervention demands more debt, more distortion, and more faith in a system built on leverage. Each rescue simply plants the seed for the next collapse. The Great Depression also revealed how deeply connected the world's economies had become. When US markets fell, European banks, already weakened by war debt, imploded. Germany descended into crisis, resentment spread, and political chaos followed. The world learned that economic pain doesn't respect borders. Today, the same truth holds, only magnified. Global debt now surpasses $300 trillion. A single default or currency failure can send shockwaves through every financial system on the planet. The web is vast, but no stronger. In 1929, policymakers believed they could restore confidence with optimism and small adjustments. They misdiagnosed the disease. The problem wasn't fear, it was leverage. People weren't panicking without reason. They were simply overexposed. That lesson still hasn't sunk in. Modern central banks continue to pour liquidity into markets, mistaking money for stability. But liquidity isn't solvency. Printing currency delays recognition of losses. It doesn't erase them. And the longer that recognition is delayed, the harsher the reckoning becomes. Consider another echo from history. In the late 1920s, asset prices detached from reality. Investors justified it with the same mantra: this time is different. They believed that new technologies, new policies, and new thinking had made the old rules obsolete. Sound familiar? Today, valuations again defy logic. Companies bleed billions yet trade at record highs because belief in endless growth overshadows fundamentals. The story hasn't changed, just the characters. Yesterday, it was RCA and Bethlehem Steel. Today, it's tech giants and startups with no profits but massive hype. Debt-fueled optimism blinds investors until confidence cracks, and when it does, arithmetic reclaims control. Debt bubbles never end softly. Confidence breaks, credit dries up, and markets crumble. The only unknown is when. In 1929, it happened overnight. In our time, it may unwind slowly, disguised by policies that mask the pain. But the math is merciless. When debt expands faster than income, repayment becomes fiction. When stability depends on constant credit, it's not stability at all. It's illusion. The global economy is repeating the same fragile architecture that failed a century ago, only now it's scaled to the size of the planet. Inequality is another haunting parallel. Before the Great Depression, wealth was concentrated at the top. The rich speculated, the rest survived on credit. When the crash hit, the burden fell hardest on those with the least. Today, the gap is even wider. The top 1% owns more than half of all wealth. Asset inflation rewards those who already have assets, while wages stagnate and debt fills the void. Rising home prices make the middle class feel wealthier, but that wealth is borrowed. When interest rates rise, the illusion fades, and the anger begins. Economic inequality isn't just about numbers. It's about trust, fairness, and stability. The Great Depression fueled populism and protectionism. People turned inward, lashing out at institutions, foreigners, and elites. That pattern is re-emerging. Around the world, distrust grows, fueled by insecurity and fear of decline. When economic pain meets political polarization, history warns what follows next. Back then, governments tried austerity, cutting spending to rebuild confidence. It failed catastrophically. Today, we face the opposite trap: limitless spending, financed by endless money printing. One path leads to deflation and despair, the other to inflation and decay. Both destroy balance. Sustainable prosperity requires debt to serve productivity, not speculation. Policy must favor long-term resilience over short-term comfort. Yet political incentives push leaders toward the opposite, toward what wins the next election, not what secures the next generation. In 1929, speculation was visible. Crowds gathered outside brokerages watching ticker tapes. Today, speculation lives behind screens. High-speed trades, algorithmic bets, and layers of derivatives move trillions in milliseconds. The speed magnifies fragility. When sentiment turns, collapse spreads before anyone can react. Markets now move faster than understanding, and when trust breaks, contagion doesn't wait for explanations. But perhaps the most dangerous parallel of all lies in psychology. Every major collapse is preceded by peak confidence. People believe they've mastered risk, engineered safety, conquered uncertainty. Those who warn otherwise are dismissed as pessimists. In the 1920s, early sellers were mocked. In 2025, skeptics are labeled doomers. The cycle is eternal. Confidence breeds complacency. Complacency breeds fragility. Fragility breeds collapse. Then, shock. Still, history doesn't have to repeat. The patterns are warnings, not prophecies. Risk can be diversified. Narratives can be questioned. True value depends on trust, and trust depends on discipline. A system fails not when markets fall, but when people forget why they rose. In 1929, no one believed the prosperity of the Roaring Twenties could vanish. Yet within months, it was gone. In 2025, most people believe the same thing, that the system is too advanced to fail, too managed to break. That assumption is precisely what makes it fragile. Familiarity breeds blindness, and when the next reckoning comes, it will test not just markets, but the belief that progress can outpace responsibility. When the dust settled after 1929, it wasn't only wealth that vanished, it was faith. faith in leadership, in institutions, in the promise that hard work guaranteed security. The crash forced nations to rebuild both economies and ideologies. The United States responded with the New Deal, introducing regulation, deposit insurance, and social safety nets. These reforms didn't end the Depression, but they stopped the bleeding and redrew the rules of capitalism. For the first time, the state accepted responsibility for economic balance. Yet those very solutions carried the seeds of future fragility. Once governments learned they could manipulate markets to maintain order, they never stopped, and that legacy lives on today. Central banks inject liquidity when fear rises. Governments spend trillions to revive growth. Investors now expect rescue as a right, not a privilege. The moral hazard has become permanent. Risk is shared, but reward remains private. In 1929, such an idea would have been unthinkable. In 2025, it's expected. This is how history drifts. Emergency actions quietly become doctrine. What begins as an exception hardens into routine. The Great Depression taught leaders one powerful lesson: deflation destroys. When prices fall, people stop spending, companies hold back investment, and jobs disappear. To prevent that spiral, modern economies learn to tolerate inflation. But this acceptance carries hidden costs. Persistent inflation eats away savings, rewards debt, and punishes discipline. It transfers wealth silently, from savers to borrowers, from workers to asset owners. The system now relies on that invisible shift. It cannot allow prices to fall, even when correction is natural. That's why every modern crisis ends in bailouts, not bankruptcies. In 1929, markets were smaller. The crash, though immense, was mostly national. Today, they are planetary. Capital moves at the speed of light. Derivatives tie banks from New York to Frankfurt, from Beijing to Sao Paulo. A single policy mistake in Washington ripples through the world within minutes. The network built to distribute prosperity now multiplies danger. When one node fails, contagion is instant. That's why even small disruptions trigger global tremors. The very structure amplifies every shock. The Great Depression reshaped geopolitics. Economic collapse fueled nationalism, protectionism, and ultimately, conflict. Desperate populations turn to strong men who promise certainty. Today, the echoes are unmistakable. Economic anxiety breeds political extremes. Populism spreads. Faith in democracy erodes. When opportunity feels rigged, people crave control, any control. That was true in 1933. It is true again now. The original crash was born from faith that markets could self-correct. Today, we cling to the belief that governments can always intervene. Both beliefs are illusions. No system escapes arithmetic. Debt exceeding income, speculation exceeding production, promises exceeding reality. These forces always converge. The longer we deny them, the more severe the reckoning becomes. In 1929, few understood how tightly finance and daily life were intertwined. A farmer in Kansas didn't see how Wall Street leverage dictated the price of wheat, but when credit froze, his world collapsed. The web is more complex now, but no less real. When central banks tighten policy, mortgage rates surge, housing slows, jobs vanish. The feedback loop is faster, the impact deeper. Ordinary people, not algorithms, pay the cost. Technology has changed the scale, not the nature of markets. In the 1920s, ticker tapes spread prices with delay. Today, algorithms react instantly without judgment. Fear and greed, once human, are now automated. That makes crises more violent. When machines detect a drop, they sell. Selling triggers more selling. Liquidity disappears in seconds. What once unfolded over weeks now happens before markets even open. The speed has changed. The consequences have not. Yet there's another lesson from 1929, one of resilience. Out of ruin came reform. Out of despair came reinvention. The challenge for our generation is to adapt before collapse, not after. We already know the signals: excessive debt, inflated assets, inequality, and overconfidence. We also know the solutions: fiscal discipline, productive investment, shared growth. What's missing is willpower. It's easier to delay the pain, borrow another trillion, print another rescue, but every postponement compounds the reckoning that follows. If you read history closely, one theme repeats: denial. Journalists dismissed the first market drops as healthy corrections. Politicians called them temporary turbulence. Bankers insisted fundamentals were sound. By the time they admitted the truth, the foundation had already cracked. That psychology, the refusal to believe, is timeless. It surrounds us again. Markets remain euphoric. Valuations defy gravity. Central banks promise stability. Yet beneath the surface, strain builds. When future historians study this era, they will ask the same question we ask about 1929. How did they not see it coming? And the answer will be identical. They did see. They simply chose not to believe. Comfort feels safer than correction. That is the core lesson of every crash. So where does that leave us? The global economy stands on a familiar edge. Growth slows, debt climbs, inequality fuels resentment, institutions strain under pressure, technology accelerates everything, both progress and fragility. The pattern is ancient, the context is modern. The Great Depression proved collapse is never purely financial, it is moral. When trust erodes, systems follow. The challenge today is preserving that trust before another reckoning forces renewal. Because every crisis is both an ending and a mirror. It reflects our collective choices, the ones we justify, the ones we postpone, and the ones we ignore. If you've followed this far, pause and look closer at your own economy, your savings, your cost of living, your sense of opportunity. The ghost of 1929 doesn't haunt museums, it hides in daily decisions. Every time we chase profit without purpose or substitute speculation for growth, we invite the same cycle back. Crashes don't appear out of nowhere. They germinate quietly in belief that this time the rules are different. So ask yourself honestly, if the conditions of 1929 returned today, would we recognize them? Or have we built a system so complex, so confident, that it no longer sees its own reflection? The answer will decide whether the next decade repeats the past or finally learns from it. If this perspective made you question today's economy, share your thoughts below. Are we wiser now, or simply walking the same path in better suits? History isn't behind us, it's repeating, just in slower motion.